All right, Steve.
Hey, Paul.
Friday, TGIF.
Yes, it's been a while since we've blessed the internet with our wisdom.
I know, a couple of vacations between us and nothing too new to discuss. So yeah, we haven't done this in a while.
Yeah, thankfully nothing too new to discuss, I suppose.
Yeah. And I think from when we first started this, we were barely even seeing each other because we were working remotely. Now we're back in the office for the most part, seeing each other all the time. So we are chatting in the hallway at the water cooler, as it were.
Yeah, definitely. Well, just to kind of kick off a discussion, I think one of the things that I probably get asked more than any other is what type of entity should I be? Should I be an S corporation or should I organize as an LLC? And I just thought that would be some good discussion that we could have and maybe provide some insight to our clients.
Yeah, I think that's a great idea. It's funny, those two, because of course there's also C-Corp and there's also just general partnership, but
Yeah.
you know, of all of the business entities we do, and you know, I guess it's worth saying 70% of the work that we do is business entity tax work. And
Right.
I would put it at 95% of those business entities are either LLCs or S-Corps. We have very few businesses that are still organized as C-Corps. And yeah, very few as general partnerships.
Yeah, it's funny that you mentioned that because, as you know, I'm in a master's in tax program and studying corporations. The C Corp, frankly, with the new reduced rate, that 21% tax rate, does have some new advantages, especially like if you were able to sell the stock. There's a 1202 exception to selling your business, and you could actually like exclude several $1 million if you were to sell your stock and you're organized as a C corporation.
Yeah.
So.
Yep.
All right, but going back to LLCs and S corps, I think just to maybe provide some of the major differences that I see is one, with an S corp, the income has to be allocated directly to the shareholders in proportion to the shares owned, as opposed to with an LLC, you definitely have flexibility in how you allocate that income, how you allocate losses. You can definitely kind of move things around a little bit more so.
Yeah, I would agree. I mean, I think that flexibility is the word that describes the key difference between those two. You're able to specially allocate on an LLC. And I think it's worthwhile to step back and say an LLC is an LLC is really a term of the type of entity it's organized with the Secretary of State. It's really more a description of the state laws that govern its, credit liability limitations and things like that. So for tax purposes, an LLC can elect to be taxed as any type of entity, but it's default taxation, and 98% of the time it's a partnership. It falls under the partnership tax rules.
Yeah, no, that is true. You occasionally do run across the LLC tax as a corporation. I still haven't figured out exactly why. I mean, I guess I shouldn't say that, but it's very rare. That's for sure.
I have a couple, and usually it's at the attorney's request, because there's it's organized in a different state. Like the ones that I'm thinking of off the top of my head are in Texas, and the state of Texas may have some better privacy protection laws and things like that for an LLC versus an S corp. Yeah. So this entity is an LLC taxed as an S corp.
Yeah. So I think that flexibility factor, if you've got maybe one guy that kicks in the money and the other guy that's performing services, and you don't necessarily want to allocate stuff 50-50 or in proportion to ownership, you can do those special arrangements with the LLC that you just can't do with the S corporation.
Right. And I think from a general concept with partnership slash LLC, the tax law views, for the most part, partners as being an owner of their proportionate interest of the assets and subject to the proportionate interest of the proportionate portion of the debts of the partnership as well. So you can much more freely move assets in and out of a partnership or an LLC without tax consequences. Now, I don't want to make it sound like there aren't, because there are certain situations where there are, especially if there's debt that gets shifted around, or there's gain on assets that another partner contributed. But for the most part, you can much more freely move assets in and out of a partnership. Whereas with an S-Corp, the minute you start pulling assets out, you're going to be recognizing gain for the most part. Which
if you put in appreciated assets in an S corporation, and it's got a low basis, you're recognizing gain on the distribution of that, because you have to distribute those assets out at the fair market value, as opposed to like with a partnership, it gets pulled out at the adjusted basis.
Right. Yep.
I actually have a client, and they're trying, these two parties don't get along, but the property is appreciated several $million, and to pull the property out of the S Corp that was organized in 1959 or whatever is just too great to be able to do that. So they kept him in there and continue to try to get along, I think.
Yeah, so maybe this was organized a long time ago, because it does seem like the de facto entity structure for real estate holdings, at least since the LLCs came about, which I'm going to guess was 20 years ago, maybe 25, something like that. But LLCs are by far the method used mostly.
I think just another thing, couple things to mention for the differences, how California treats them from a state tax standpoint. Now, these are both flow-through entities, which means that they aren't typically taxed at the entity level. The profits and losses flow through directly to the members or the shareholders. However, California wants their piece, and so both of them are taxed $800 per year, a minimum tax. But for an S corporation, they pay a 1.5% tax on the net income of the business. Whereas an LLC, they have kind of this tiered structure where they pay an LLC, I think it's $250,000, you pay another $900 at like $500,000, I think you pay another $2,500, and then over $1 million, you pay like $6,000. So, and that's on the gross receipts number versus the bottom line number. So kind of a little bit of difference there.
Yeah, it's hard to, often the question that is posed to me is which one's better from a tax standpoint.
Right.
And it's hard to equate the two, since S Corps are taxed based on that 1.5% state of California based on net profit, but LLCs are taxed based on gross revenue. So it's hard to equate the two and decide which one's better from a tax standpoint.
I mean, I suppose if you had like really high revenue but low profit, wouldn't you want to be an S Corp maybe?
Yeah.
I mean, and it's 1.5%. I realize it's
right. So, and if you do the math, since there's an $800 minimum tax, and it's the greater of that $800 or 1.5% of your net profit, it's you don't really start paying tax on an S Corp until you've got net profit of $50,000.
Right. True.
The other thing that factors in to the tax implications is payroll, right? Because if you own an S Corp and you work in that S Corp, you're required to pay yourself a reasonable salary. And so that reasonable salary is a deduction. It reduces the net profit of the S corporation, but that reasonable salary is subject to payroll taxes. And you're going to pay payroll taxes on that. Whereas in an LLC, you can't pay yourself payroll. But if you're working in an LLC or there are other factors here, but the profit that flows through to you from an LLC is going to be subject to self-employment tax, which really equates to the same thing as the payroll taxes paid out of an S-Corp. So payroll does factor in, because if you have profit in excess of, in an S-Corp in excess of what you pay yourself in payroll, you might save a little bit of tax on those payroll taxes.
Yeah, I think that can be a huge thing, because the excess profits aren't subject to self-employment taxes on an S-Corp, you know?
Yeah, we're gonna get very complicated here, but you're right. But those excess profits in excess of 50,000 are subject to the 1.5% California tax.
Right?
So here's the way it always comes down to me, because that's usually the way these questions get posed to me is,
Right.
hey, why don't I just have an S corporation and not pay myself any salary, and then I
Right.
can save on the self-employment tax that an LLC would be subject to. So once your wages are over that FICA base,
Correct.
then your wages are only being subject to the 3.8% Medicare tax. So now you're just comparing the 3.8% Medicare tax to the 1.5% California tax on an S corp. So that savings isn't that great.
Yeah.
And it seems very unlikely that you can justify a reasonable salary under 140,000 for somebody who's an owner or an executive of a business that's being operated.
Yeah.
And then you got to factor in retirement benefits. I mean, if you pay yourself, your ultimate Social Security benefits are based on your highest wages. Well, if you're not maxing out on those FICA wages, then you're
Right.
not going to get the maximum Social Security benefits when you retire. So that question of, all right, well, can I just open an S corp and not pay myself anything and therefore save payroll taxes?
Yeah.
It's a much more complicated answer, and one that frankly never justifies the amount of work that's required to figure that out.
And it seems like every year, whenever there's an election, that seems to be like a hot topic is, I'm going to eliminate the pass through of S corp earnings without being subject to self-employment taxes. It seems like you always hear that they're going to try to eliminate that, which would eliminate the whole reasonable comp issue, I would think.
Yep.
Very good.
You got any other distinctions between those two that you often come across?
What I could think of.
I think if I'm giving advice on it, I would rank non-tax issues as the number one thing to consider between those two. It's liability protection. Which law gives you the type of liability?
I don't think that we can advise necessarily on that.
So your attorney is the first person to advise on the best thing to protect you based on the type of business you're in. So sometimes, if they're a contractor, that's a consideration, is who gets the license with the what's that, the State Board of Contractors license board. That factors into it. And then the second tier after liability limitation is what you brought up originally, which is flexibility in your agreement with your partner or your other shareholders. What do you need to accommodate that? And then third on the list would be taxes, because there's not a big difference between the two.
Yeah, I would think so too. Yeah, as well. The flexibility factor, how many members? I mean, I guess you also have to look at eligibility, at least related to an S corporation. You can only have, I think, 100 members. They've all got to be US residents, I think. You can't have a partnership that owns or is a member of an S corporation, so that could blow your S election. Whereas you don't have that type of issue with the LLC.
That's right. That's a good point. The other thing I guess it's worth just mentioning, and I think we've mentioned this before, but related to pass-through entities, not necessarily a distinction between the two, but just want to reiterate, the state of California has passed this elective pass-through tax. That's a way to get around the individual deduction limit on state and local taxes.
Yeah.
Worth mentioning. So we're sitting here, it's August 6th, and this law was passed, I think about 2 weeks ago, if I remember correctly. So we're waiting to hear from the state on how to apply this. And when we do, we're going to be contacting our clients. But owners of pass-through entities are going to be able to elect to pay, to have those entities pay state tax, which will reduce their flow through income and thus get around that $10,000 state tax deduction limitation that was put into place from the Tax Cuts and Jobs Act of 2017, 18.
Yeah. Yeah.
I think that's an exciting development, for taxpayers that own pass-through entities.
Yeah.
And frankly, potentially a reason for, sole proprietors and people organized in other types of entities to consider switching over,
Yeah, so if you're a sole proprietor, you wouldn't get that.
That's right.
As opposed to, if you were, that's a big consideration.
So we're gonna have to figure out, we need guidance. We don't know anything other than this conceptual framework for this. But, if you're a sole proprietor, can you elect to be an LLC and be a single member LLC and have the single member LLC pay this tax? I'm not sure about that. I kind of don't think so.
Yeah.
Because
It'd be really interesting for California, because then all of a sudden everybody's is organizing all these sole proprietors. They're collecting like a gajillion of those $800 fees.
Yeah, and that's interesting. I hadn't thought about that till now, but I bet that they factored that into their analysis as to whether they wanted to do this. Is all the businesses that aren't organized in one of these pass-through entities suddenly organize and they start getting $800. They get their LLC fees, or they get their 1.5% tax on S-Corp earnings.
Yeah.
That is interesting. I bet the state will get some real revenues out of that. All right, now that we're bitter, we should probably stop talking.
Okay. All right.
All right, well, have a good weekend.
Thanks. Yeah, you too.